just months before the collapse of Silicon Valley Bank, the bank's lobbyist groups fought a proposal that would require financial institutions bolster the FDIC. So now the FDIC, also the Federal Deposit Insurance Corporation, organization that was set up after the Great Depression. So the 1933 Banking Act, which brought us a lot of great things that unfortunately lobbyists and corporate Republicans, corporate Democrats teamed up together to water down. Well, look, it brought us a lot of great things like the FDIC. Now, the FDIC is funded by its members and currently covers lost deposits up to $250,000. So now, after the fall of SVB, a lot of people are looking at that and saying, you know, $250,000 might not be enough to cover all the depositor losses. Well, yeah, that makes sense. Now, again, the fund not having enough money to pay for it in the event of a financial crisis, that's a big issue. And it's an issue the FDIC is quite well aware of. And so they actually tried to craft a rule to bolster just a little bit. Just a little bit. So now, after they proposed this rule, they got massive pushback. According to The Lever, last year, bank lobbying groups mobilized against the FDIC's proposal to raise banks' insurance premiums to shore up the deposit fund's reserves, which had actually fallen below the minimum required by law. So, again, you're supposed to have a minimum amount of money in the FDIC, which, again, had been depleted several times, actually. So, in fact, the last time it ran out of money, I believe, was in 2008. So, yeah, that's an issue, okay? You would think that, hey, maybe we should regulate the banks to make sure that they pay in enough money to the FDIC so that if this happens, they have enough money to cover the depositors. Now, lobbying groups, however, representing Silicon Valley Bank, argued that the risk of bank failures was low and insisted that requiring banks to pay more into the fund would actually harm their financial institutions' bottom lines.
Oh my God, he admitted.
My profits, my beautiful, beautiful profits. How dare you make us pay more into the insurance fund? I mean, it's not like we're ever going to need it. Wait. Yeah, I just love it. Well, the risk is just so low. Oops. Now, numerous other enhancements to prudential standards have also encouraged banks to strengthen their balance sheets and risk management, said an August 2022 letter to regulators from lobbying groups, including the American Bankers Association, the Bank Policy Institute, and the Mid-Sized Bank Coalition of America, all of which counted Silicon Valley Bank as a member. And they said the proposed increase would unduly burden the banks and may harm the broader economy. Well, what happens when you have a run on banks? Oh, right, you harm the broader economy. At the time, the Deposit Insurance Fund had less than $126 billion to insure the nearly $10 trillion of insured deposits in America, meaning the reserve ratio was below the statutory 1.35% minimum. Wow. So, yeah, seems like a problem. Again, since we live in a country where we don't have enough regulation, proper regulation, causing, of course, constant economic crashes caused by banks making and losing risky bets. You would think that at least having an insurance fund that has something in there, just in case of an emergency that prevents a collapse of the banks, would be smart. No. Apparently not. That would be a burden on business. Too much of a burden. Look, soon after the bank industry's letter, by the way, you had a group of senior Republican House lawmakers that pushed back against the FDIC, fought against this rule. Thankfully, they lost. But again, you have reports of even Kevin McCarthy, and again, numerous Republican leaders pushing for not only to block this rule, but also to deregulate the banks further. A lot of these senior Republicans were unsurprisingly just bathing in industry cash. Yeah, but I'm sure that's just a coincidence, right? I'm sure. They just really cared about not unduly burdening the banks, who just happened to be funding their campaigns. Now, SVB was also directly lobbying the FDIC last fall during the rulemaking period, according to filings reviewed by the Lever. Now, despite the pressure, the FDIC did finalize the proposal order in October, asserting that it was necessary to maintain statutory minimums and guarantee banks were adequately insured in the case of collapse. Now, again, in the case of SVB, about 85 to 90% of the depositors were not insured. So, wow. Now, I told you, their response to this regulation was, it's going to hurt us so bad. Well, how much? How much were they going to actually hurt these banks? Well, apparently, their reduced earning would be equal to about 1.2% of their income annually. 1.2%. That's it. And yet lobby groups called this aggressive and said the assessment rate increase is unwarranted. They also said, by the way, this is Republicans now. They also said, we are concerned that an increase in the assessment rate at this time could pose real harm to consumers. Yes, because we care so much about consumers, particularly those with low and moderate incomes who may need access to credit. Said a comment of the proposed rule from Republicans Representatives Blaine Luetkemeyer, Anna Wagner, Andy Barr, Bill Huizenga, and Tom Emmer. It is in their best interest to allow the fund to naturally recover over time as deposits run off. Those five lawmakers that I mentioned received a combined $942,000 of campaign donations from the banking sector in the 2022 election cycle. But I'm sure they just, again, cared. They cared so much about the consumers. Yes, they're very, very concerned with the consumers. The banking industry groups also oppose the assessment and are as follows. The Bank Policy Institute, the American Bankers Association, the Consumer Bankers Association, Independent Community Bankers of America, Mid-Sized Banks Coalition, and they had all called this final rule a, quote, preemptive strike against a non-existent threat. Now you look out there and you tell me how non-existent that threat is. Oops. So yeah, now look, there are people out there calling on Congress and regulators to consider temporarily raising the $250,000 limit on deposit insurance. This is Representative Josh Gottheimer who's pushing that. Now look, I don't necessarily have an issue with that. Again, as long as it's paid for by the banks. $250,000, as I mentioned, quite small. Now, banks have been fighting against raising that limit because, again, they would have to pay more into the FDIC fund, which would impact their profit margins. Yes. Oh, and also, the U.S. Senate Banking Committee for the GOP called for more deregulation. So, again, at the behest of these bank lobbyist groups. So, look, the fact that we have a government that allows for private corporations to give unlimited amount and private individuals to give unlimited amounts of money to political campaigns and to call it speech or whatever. I mean, that's opened the floodgates to, well, this corruption, where you have industries paying off politicians to then pass laws on their behalf, which then, ironically, ups the risk for the rest of us. Again, there are people, normal people, depositors, people who put their money in these banks that were at risk of not being able to get their own money out because of the risky bets of these companies and because of the deregulation, not having enough money to cover their bets. That's the issue. We need these rules back. We need Glass-Steagall. We need, obviously, more funding in the FDIC. And we need to reinstate the 2018 Trump deregulation, or reinstate the regulation that Trump got rid of in 2018, which would at least, again, have some cash liquidity requirements and stress testing to make sure that these banks don't fail the way that they keep doing. So, but unless there is a political will to fight against the banks, we won't do it. And we'll just keep seeing disaster after disaster.